Okay, so good afternoon, everyone. Let's get started. Thanks again for coming. Hope you had a nice morning and a nice lunch. I've introduced myself in the beginning, so I'm Rodrigo Cabral. I work here for the World Bank Treasury. It's really a pleasure to be here. It's really a pleasure and an honor for me to have such distinguished speakers with me today. I'm looking forward to the session. I'm going to introduce Jim, Robert, and Leo in a moment for those who don't know them yet. First is some very quick opening remarks. When I was thinking about this session, also thinking about my professional background, I thought the session would be very interesting for me because before joining the bank, I was working at the Brazilian Treasury. And when I joined the Brazilian Treasury in 2001, at that time, there was a very active dialogue about linkers. At that time, Brazil had already issued a couple of linkers, but there was still a debate whether these instruments would be beneficial or not, some concerns about not helping with the desindexation of the economy or the market or fragmentation and so. And today, when I look at Brazil, Brazil is among the emerging markets, is one among the highest shares of linkers. So I see this story, how this story developed. But also when I look at other countries, I think a similar story happened across many countries. So we have here Robert from the UK, and we saw the UK increasing also a lot, the share of linkers. The US, I think it's in absolute terms, is the biggest issuer of linkers. But also we saw like France and Sweden and Canada all going for linkers as an important instrument in their funding programs. And the same trend we also saw, at least in some of the emerging markets or some of the big emerging markets like South Africa, like Brazil, Turkey, and Mexico. So looking at all of that, we thought that it would be nice to have this session as an opportunity to look at these instruments, to look the importance, how they are used by different sovereigns, to discuss how similar they are, how different they are. Of course, there are differences in terms of their structure, in terms of how the auctions are made, in terms maybe of the rationale for having the linkers in the debt management strategy. So we really hope that this session is useful to promote this discussion among we all. And I know that we have a number of representatives in the audience coming from countries that also use linkers a lot. So I really encourage you to actively participate in the debate. And finally, I hope it's also helpful for those countries that are not using linkers but are thinking about it. So at the bank, in our work in providing advice to countries, we see a number of countries thinking about starting the issuance of inflation linkers. Sometimes it's trying to extend the yield curve. Sometimes it's to try to replace existing bonds that are indexed to FX, for example. But so for a number of reasons, there are countries that are thinking about it. So we also hope that these three very rich experiences and experiences coming from the audience can also help countries that are thinking about it now. The plan for the session will be the following. We're going to have three presentations from South Africa, the UK, and Israel. We're going to ask the speakers to use no more than 15 minutes. They're going to show us their experience with those instruments, and then we're going to open for Q&A. So we're going to take questions only after the three presentations, because I guess at least part of the questions could be addressed by the different speakers. And I will introduce the speakers as we ask them to present. As we've done in other sessions, I will do just a very short bio. You have the complete bios, which are quite impressive, in your folder. So let me jump right away to our first presentation of the day, which is going to be Jim. So Jim Matsimela. Jim is the Director of Market Risk in the Asset and Liability Management Division of the National Treasury in South Africa, where he's responsible for market risk management of the government's debt portfolio, but also for overseeing the team that implements methodologies for quantifying the government's exposure to contingent liabilities arising from guarantees. And as you know, we're going to have a separate session in the forum to look only into the guarantees issue. Jim has a vast experience in the South African Treasury, having been involved in several important reforms, one of them being exactly the introduce of linkers back in the beginning of the 2000s. So, Jim, thank you very much, and the floor is all yours.
Thank you very much. Good afternoon, ladies and gentlemen. I'm going to take you through, first of all, let me request to present seated, if that's okay with everyone. I would prefer that. But in these few moments or 15 minutes, I aim to share South African experience on issuance of inflation-linked bonds, what actually inspired us to issue them. But first of all, let me just jump straight into the presentation. I'm aiming to jump most of the points there, but just touch on the evolution of the debt management objectives, which have guided the debt strategy to a large extent. But principally, if I may touch on 2005 onwards, when the risk guidelines were linked to the funding strategy, where not only the risk guidelines were linked to the funding strategy, but also taking into consideration the fiscal policy objectives. So then we thought annual funding strategy ought to be underpinned by risk guidelines, but most importantly, the debt structure or the composition thereof should be able to insulate the annual budget from volatility in interest expenditure, caused possibly by variation in your interest rate, inflation, as well as exchange rate. And we thought the debt structure really should assist government in realizing some of the fiscal policy objectives, and principally being debt sustainability and intergenerational equity. The problem with that is that we may have to look at the impact of indexation, whether that serves that objective much better or not. Just to move on, a little background to the introduction of inflation-linked bond in South Africa is that we, in 2000, started issuing the very first inflation-linked bond, which is worth a 13-year, at a very high coupon, surprisingly, of 6.25%. It's very high compared to the most recent we've issued, like 2%, 3%. The reason being, by then, not a lot of people understood the pricing mechanism of inflation-linked bond. So we've had to settle for something that is really high in terms of a coupon, the initial coupon. But currently, government issues across the curve, as you can see, the 5-year, the 7-year, those critical areas like your 10-year, your 15-year, 20-year, 28-year, and out to about 30, 32 years. We've even issued a 3-legged or split maturity inflation-linked bond for the first time. This has normally been the practice of South Africa to issue conventional bonds on a 3-legged basis, but we've added to the suite of those 3-legged by issuing an inflation-linked maturing in 2049, 2050, 2051. The structure of our bond, or ILBs, is principal indexation and not so much interest indexation. And the funding share is about 20% of the overall, not overall, but the long-term funding, excluding the Treasury bills. But it's slightly lesser if you include the Treasury bills, which means on the overall basis, it's about 17.6%. Long-term, 20%. The portfolio share, I spoke about the funding share. The portfolio share is a range, a benchmark of a range between 20 and 25%. And this we've determined on 2014-15 fiscal year. As you can see on the right-hand side, we've got about no less than 3 benchmark indicators speaking to the inflation risk exposure. The first one being the share of inflation-linked bonds in the overall portfolio. Before that, we used to lump the interest rate as well as the inflation exposure together. But since 2014-15, we thought of separating the two. We introduced the average term to maturity for the first time for inflation linkers. And those are the new benchmarks that we've introduced. Okay, just to speak about the actual funding split, I said 20% of that is in linkers and then about 80% is in fixed rate bonds. If you look at the performance from March 2016, we've held to the funding guidelines, about 20%, 20%. Only in June 2018 do we see a dip, but there's also a dip somewhere in March. The problem with linkers is that in meeting the cash is that sometimes we have a lot of undersubscribed auctions because no primary dealers don't have an obligation to make a market, unlike in your conventional bonds. On your right-hand side, you see the portfolio split. That one was the funding split. The portfolio split to date, we're still within the risk guidelines, even if this year we're reviewing those benchmarks. Next year, we're hoping to have a new set of benchmarks, either the same or slightly different to this one. The market has gotten used to these ones, so we may introduce just to improve on the ones that are available. What was our rationale for issuing linkers? In the research that Treasury conducted in 1999, it was observed that a number of countries who introduced these bonds have gone through roughly the same checklist. What is the choice of index to use? What would be the relative frequency of issuance and the size thereof? And what about liquidity? How do you address the pricing and the tax issues? But then there are a few cases maybe to make, or arguments. The one being the strong macro policy case, which says this gives a strong signal of the intention of government to control inflation. When we issued inflation-linked bonds, that was the same time when the central bank, the Reserve Bank, introduced the inflation targeting. So the two started off together, and then I think they moved along. Secondly, it's a demonstration for government to commit towards prudent macro policies, perhaps not just in theory, but we'll see how that pans out in practice. I actually put a slide there to show that it's with the structure of the market. There is a strategy, there is a structure of the market. And in this instance, there has been a change somewhat in the structure of the market. If you look at non-residents, they've increased their holdings of local bonds, whereas the pension funds have actually decreased. But you'll see later on that they've upped their holdings of the inflation-linked bonds and reduced drastically their holdings of the FRBs. If I can move on. The second case or argument being that the debt or fiscal policy argument, that government saves there is premium somehow over time. It even pays actual inflation, which is even backloaded by issuing linkers, all right, and then actually rather than pay the excessive market premium priced in conventional bonds, correctly or incorrectly, wrongly or rightly. Secondly, government's willingness to assume inflation risk, the financial risk of inflation, while transferring the market-making risk of conventional bonds to the market. As I said, we don't have an obligatory primary dealer system on the linkers, but we do have on the FRBs. Importantly, the third one, as I presume, it's the asset liability matching from investors. I think that one would be the most important one if you look at the liabilities of pension funds. To that extent, we've served that objective in my view. Okay? And if you look at the far right-hand side, as I said, the foreigners or holdings of ILBs by pension funds is actually higher compared to the chart below, which shows the holdings of conventional bonds being slightly lower. Okay, when we computed, or when we did the 2014-15 review of the benchmarks with the help of the World Bank, thanks to Shishdam, we have had to compute them backwards to see, over time in history, how would the strategy have performed if we have opted for the split that we decided in 2014-15. Later on, I'll speak about the forward-looking one. But over time, you see, if you look at the evolution of the debt exposure and inflation-linked bonds, I think they are the blue ones, the dark blue. They start, rising exponentially low and then picking up. They just rise exponentially, which is a worry if you hold them for much longer, because then you bridge the benchmark, but then the indexation point comes into being. Unlike your T-bills, which shoot up and then they are actually corrective. We don't have a problem with T-bills, although we've got a benchmark, a limit actually. There is not so much of a challenge when it comes to the T-bills. However, the benefit of linkers is that they just pull your average cost of debt down. That's the benefit. If you look at the share of ILBs, just the lower one, we've looked at how it performs since we've introduced the reviewed benchmarks 2014-15. You see that we've never breached the benchmark. And those are the strategies. The 90-10, we've explored about 5, whereas in the past we'd only had 1 strategy. So there will be one extreme strategy which skews you away from the range somewhat, especially if you look at the 60-40, it goes upwards. But then if you look at the next extreme will be the 90-10. Maybe I should explain what is 90-10, what is 60-40. 60% of the fixed rate, 40% of the ILBs. 90% of the FRBs and 10% of those are the strategies. We only use the 2 instruments. The refinancing, I can jump a little bit. We also, as I said, introduced the ATMs for ILBs for the first time 2014-15, and we have had to compute them back in history to see how that would perform. You see the start being up, or rather on the 13-year area, and then dipping down a little bit and then rising again. But this is because our allocation strategy has moved from the mid part towards the long part. About more than 70% of the issuance is in the longer end. We don't even issue anything in the 10-year area. And then this is a problem for the FRBs because duration has increased so much. But duration is not a problem, I suppose, for the linkers, because that one is a buy and hold. And then pension funds are meant to hold them, if possible, until maturity. There is no tradability as such, although I think there might be a small amount of that. ATMs have peaked in 2016-17 for the ILBs in particular, and they are coming off a little bit. And then per strategy, you can see how they perform. The ATM, or comparatively, of the FRBs plus the ILBs have shot up, and then 2019 or 2018-19, we expect them to come off a little bit. We've also computed or added other cost affordability indicators. If you look at the ILBs to GDP, they seem rising until 2017-18 and coming off a little bit. But per strategy in the medium term, you can see if you choose the 60-40, obviously it will skew you away. And then if you choose the 90-10, yeah, it will be a much lower or less costly strategy. Revaluations to GDP on the right-hand side, the top, 4%, I think rising 4% of GDP is quite a lot. And this is, remember, increasing exponentially. So the issues of indexation of the economy might come into being. Revaluations to revenue is even higher, 17% has risen from about 11, 12. And if you look at the strategy, it's even higher depending on the extreme one you choose. And cost to revenue, I think that one was just added as, yeah. The interesting one for me this time is how is the annual turnover in ILBs compared or comparing to the annual turnover or the monthly turnover for that matter with FRBs. Now, the turnover of ILBs is just a small amount compared to about 6.4 trillion in FRBs or conventional bonds. Due to their liquidity, perhaps illiquidity, we see about 325 billion annually compared to the trillions, in FRBs. But then if you look at the turnover as a percentage of outstanding, it's more spread out in ILBs, the left-hand chart, and then more concentrated, if you like, for the FRBs, okay? And then the R197, perhaps I should cite the maturity. The bond maturing in 2023 and 2033 have been off the run for a while because of their extreme index ratios. They're too expensive. I think the price is about 300%. But cash-wise, government, the nominal equivalent we need to issue is much, much lower. We're just worried about the indexation effect. So we try to limit that, hence we've got that range. We don't even change that range. But the benchmarks obviously have held 5 years, and then obviously we'll see how it comes out after the review. All right, only recently in September have we reopened those two bonds, which I said they're expensive, due to the liquidity or the cash targets. Okay. Market for linkers to continue. Well, since 2005, we've auctioned the linkers on a uniform price basis. We actually started the two auctions in 2000 uniform price basis so that we gauge where we can set the coupons. And afterwards, we went to the multiple pricing, and only in 2005, about 5 years later, then we switched back to the uniform pricing. So, but similar to Treasury bills, linkers, as I said, they have no primary dealers appointed and compelled to submit bids. But this somehow, as I said, poses a risk to the auctions. We can have an undersubscribed auction, as we often have. Now, taking part in weekly auctions is open to members of the JSE. Anybody who wants to come through the auction, the primary has to get through the PD. A member who is a JSE member, sorry. Now, if you look at the break-even rate, I think this is unfair because I use the 7-year, whereas we issue in the 20-year plus. But be that as it may, the break-even compared to the actual inflation has been higher, around between 5 and 6%, but it's even higher in the back end where we issue mostly. It's about 6.4. It's higher than the target range of the central bank. So I think that's just the picture. They've been behaving. I think there is a correlation if you think close enough. I think they've been moving together, but then it's increasing in the back end. Are there any possible drawbacks if we look back, standing in today and looking back to the time we started issuing the linkers? In terms of investor base, we'd say the pension fund holds between 40 and 60% of the linkers, compared to about 2 and 25% in conventional bonds. Now, of the 40% SA bonds held by foreign investors, linkers comprise only a small proportion. As to the lengthening of the curve, we see no constraints in lengthening the nominal curve, all right, except dispensing with the old practice where we used to overlay an ILB maturity together with a nominal maturity. So we've gone away from that practice. About indexation, as I said, I think SARP dispensed with the CPIX and then started using the same headline measure as that used for the linkers. Thank you very much for your patience.
So thank you very much, Jim. Very quick reaction before we move on to the second presentation. I particularly liked the way you talked about this checklist or all the options that you have to make, right, whenever you were launching any new instrument. And I think that's where it becomes interesting, because when I look at South Africa, for example, and you talked about this three-legged bond and the fact that you don't have the primary dealer systems acting on the linkers, or the type of auction that you select, or the indexation of principal only in your case, that's when it's going to be rich, like to discuss the different experiences that we have around. But before that, again, we're going to do the Q&A after the three presentations. So let me turn now to Robert Steeman. Robert was appointed Chief Executive of the United Kingdom Debt Management Office in 2003. The UK DMO is an executive agency of Her Majesty's Treasury in charge of government debt and cash management. Before his current role, Robert had several positions in the private financial sector in London and in Germany. And recently, he received a knighthood in the Queen's New Year's Honor List 2016. So we're very pleased to have you with us, Robert, and please, the floor is all yours.
Can you hear me? Yes, thank you very much. Somebody once asked me, what do you get a knighthood for? And I said, well, you get a knighthood for slaying dragons and rescuing beautiful maidens who've been imprisoned. I think it's the sort of thing we do every day as debt managers. Let me just I do have some slides, but fear not, I will go through them very quickly, which is really just to give you a sense of our market. And actually, I was genuinely very interested to hear Jim's presentation because there are indeed some parallels. Our market may be older, but a lot of the considerations that we have are ones which clearly we share as well. So let me see, does this work? Yes, it does indeed. So the rationale in particular, it's worth noting that we first issued inflation bonds as long ago as 1981. Apparently we were the first G7 country to do so. That's phrased carefully because there are one or two people who, have delved into history and worked out that actually other countries have done this. But I'd say in modern times and modern debt management times, we were the first country. Now, those 4 ticks that you see next to the original rationale for issuing government bonds linked to inflation, that was actually what was published at the time in 1981, and it shows you perhaps how, to some extent, things have moved on. So probably of those 4, the most significant really at the beginning was the desire to reinforce the UK government's anti-inflationary credibility, its stance. And again, for those historians, some of you may be aware that Britain in the 1970s in particular went through periods of very high inflation. And the desire to find inflation protection was extremely high at the time. Number of other points there. The last one I'll just focus on, which about benefiting the pensions industry, because it is actually linked to the desire today of reducing debt servicing costs. The pensions industry until then in the UK, it's always been extraordinarily large by international standards in terms of its involvement in financial markets, the private pensions industry, I should say. And for a long period, there existed in the UK what we call the cult of equity, and equities dominated pension investments. If you were to try and find the rationale today why we issue linkers, as I say, you could probably argue that most of those still apply, but we would probably change the order. So benefiting the pension industry and actually meeting our cost minimization objective at the same time would probably be up there as the most important single rationale. Finally, just to note that in the UK, both the principal and interest payments are linked to the Retail Prices Index, the RPI. Now, for those people who who like this sort of thing, we have, frankly, I think far too many measures of inflation in the UK. There is a bit of a debate developing, which I'm not going to go into here, about the future of inflation measurement in the UK, which would be the most appropriate index to use. But you're talking now about a market that is over 400 billion sterling in size, so changing that measurement is not a straightforward proposition. So I think I might have just missed one. Yes, I have. Here we go. So I mentioned the investor base. Because of the pension fund industry, pension funds basically have this extraordinary demand which has grown over time, and that demand is in its own way based on the need for them to try and hedge their own exposure in terms of private, previously defined benefit pension schemes in particular, which themselves are linked to inflation. So there is a natural demand, and I think that that is something worth emphasizing. Without that natural demand, it is, I would argue, a lot more difficult to build up a market, to build up any market. You do need fundamentally demand, both to justify what we're doing in cost terms, but also to enable a liquid market to develop over time. And it is a long process. Even today, I would not describe our inflation-linked market as being anything like as liquid as the nominal market, the conventional gilt market. And that is largely, but not only, because these are ultimately buy and hold products. If they are sought after as a hedge by the pensions industry, then by definition, there will not be a desire to trade these things frequently, except where people perhaps are buying them for different reasons. Again, the final bullet point, just referring to what I was talking about previously about no current plans to issue gilts linked to any other prices index. There is something of a debate now emerging in the UK, and it's not just confined to the Treasury. It is actually part of also a parliamentary inquiry in the UK about the use of the retail prices index, which has been deemed a flawed index just because of the way it's composed. So it's just worth noting. Perhaps also the second bullet point as well, that pension fund demand by nature tends to be really much longer than, not always, but much longer than demand for nominal debt. That is perhaps unsurprising if you think about it, but it means that what we issue in general is much longer. The average maturity of everything, and we issue a fair amount of these, over 20 billion in the current year. The average maturity of all our issuance this year is over 20 years, about 22 years of everything that we've done in that maturity. That just gives you a sense of how the market has grown over time as a proportion of the debt stock. And you can also see in particular how the size of the market in nominal terms, on the right hand in particular, just over the last 13, 14 years, in nominal terms, how that market has actually grown. It is very substantial indeed. And the grey line actually shows the inflation uplift, which is very significant in terms of its longer-term impact on the shape of the portfolio. And I note there that, at 27.5%, we have the highest proportion of linker debt. I wrote here of any major economy, frankly, of any economy with which I am aware. It's a very high percentage, and I'm going to come back to that in a second. In terms of the actual portfolio composition, I know you can see lots of lines, lots of charts. We refer to basically all our issuance is divided up into 4 categories. 3 of those are for conventional nominal debt, what we call shorts, mediums and longs. And what we in the UK call shorts, I imagine a few other countries would call mediums. That's out to 7 years. Mediums is anything between 7 and 15 years, and longs anything over 15 years. And we currently issue across the yield curve regularly, all the way out at the moment to 2071, to the year 2071, to give you an idea. And you can see there that the blue line is supposed to be index-linked issuance, and that's remained very steady, in particular over the last decade. Now, the average maturity of the actual portfolio itself has risen, but largely driven by the sheer amount of inflation-linked, I should say, because we've issued so much debt as a result, to a large extent, of the financial crisis over the last decade compared to what we were doing previously, because linkers have maintained that roughly equal share that you saw in the previous slide. For that reason, because it's so much longer what we issue, that the increase in our average maturity, of the debt portfolio, which is now about 16 years, has to a very significant extent been driven by the inflation issuance program. I talked about liquidity. There you see a chart how turnover has improved over the last 10 years. I actually find this chart just a little bit misleading, because you would expect any market turnover to increase given the sheer amount that we're issuing. Perhaps what's slightly more appropriate is to look at something like what we often refer to as the turnover ratio. How often is the actual stock turning over itself, rather than just a nominal amount of gilt market turnover. But in fairness, the inflation-linked market is probably a lot more liquid than it was 10, 15, 20 years ago. So I referred to the exposure and the size of it and the sheer scale. Some of the wording that you see there, especially the first bullet point, is very carefully phrased. And it's so carefully phrased that it's actually lifted directly from an official document of the Treasuries. And I refer to a debate that is, that is currently occurring. I'm happy to answer any questions on this later, but just in a nutshell, at 27.5%, more than a quarter of the entire portfolio, were we to continue issuing those sorts of percentages, rough, at the moment we're only issuing, we don't even issue 27%, we issue about 22%, 21% this year, and I'll come back to that. But if we hold that proportion because of the uplift, actually in 20, 30 years' time, that percentage will rise, especially in 30 years' time, to nearly 40%, according to some of the modelling that we've done. That has given government pause for thought, in my opinion, quite rightly. And obviously, while we're part of the Treasury, it's something which we've been discussing at some length in the Treasury. So when this year's financing remit, as we call it, our financing plans were announced in March, it was announced that we would be reducing inflation-linked issuance by 2% relative to the 2017-18 initial plan. And more than that, it's pretty hard for me to say, except I'll just say watch this space, because I think more may be said by government on this topic soon. So that just shows you the actual issuance again. You can't really even see the change in linkers, which is the sort of purple box at the top. It's slightly less, but 21.7%. But you can see it still remained very steady. But we're going to be looking at this, as I say, much more closely. Oh, in case you wanted to look anything up, there you've got some more details. So I'll leave it there, but like everybody else, I am very happy to take questions later.
Well, many thanks, Robert. I think it's interesting to see that although you have this very mature experience with the linkers, starting from the beginning of the 80s, some of the topics that you brought are actually extremely relevant for countries that are thinking of introducing linkers right now. So when you talk about the choice of the appropriate index, right, and especially in frontier and emerging markets, there's maybe also the question of how to ensure credibility of that index. When you talked about making sure that there is a structural or sustained demand for this instrument. Also, I was connecting to what Fred from the U.S. Treasury said today about the floating rate notes, but he was also making the case that this should be one important condition before you use a new instrument. And it is the case of some markets where the size of the market it's not big enough to allow you to think to introduce various instruments. So we'll come back to those topics in a moment. But before that, let's hear from Lior, last and of course not least, Lior David Poor. Lior is the head of the Government Debt Management Unit at the Israeli Ministry of Finance, where he's responsible for overseeing all debt management activities. Lior has been actually a great partner for us at the bank. He's speaking in conferences, webinars, and also providing technical assistance as an international expert. Lior is about to finish his PhD in economics and is also a certified global financial risk manager, FRM. So, Lior, I understand that you would prefer to speak from the podium. Feel free, and the floor is all yours.
Oh, thank you very much. So I'm not going to surprise you by saying that I'm going to speak about that my brief talk will be about the inflation-linked bond, but hopefully you will be delighted that it is a brief talk. So I don't know if you know, but a couple of weeks ago I heard that the actor Daniel Craig, known as 007, has retired from his role as James Bond. So basically they are looking for a new Bond. And I have a nice candidate for a new Bond. And I even prepared a slogan, so let's see if you like it. So, okay, thank you. Okay, so I need to improve my jokes, okay, got it. Okay. Thank you, I appreciate it. Don't worry, there will be other jokes, so you will be able to participate. Okay, so speaking about index bonds, so the concept of indexation is relatively old. Basically, in the early 17th centuries, Massachusetts, then known as Massachusetts Bay Colony, issued the first linkers, which was linked to the price of the silver. Now, since then, other countries, I think that roughly 20 countries, issued inflation-linked bond. So Israel at the middle of the 50s, UK at the early 80s, the US at the end of the 90s, and other European countries as well. Obviously, other countries have a huge portion of inflation-linked bond, especially in the Latin America, for example, Chile, Brazil, Mexico, but also other countries like South Africa and Turkey, of course, and so on and so forth. So the Israeli story in a nutshell. So Israel had three-digit inflation in the 80s and double-digit inflation in the 90s. So basically, as you can see in the left-hand chart, in 1996, 25% from the debt was foreign currency and 70% was CPI linked. Since then, we were able to decrease dramatically, so the foreign currency portion reduces from 25% to 15%, and the CPI link from 70% to 50%. Now, it's a huge number, 50% is a huge number, but we have to remember that from this portion, we have a unique tool, which is designated bond for the pension fund and insurance company, which basically from the 50%, 30% are those bonds. According to the law in Israel, each pension fund must hold 30% from their assets in designated bond. So this is kind of a unique tool for the government to support the pension fund. So the actual tradable inflation-linked bonds are roughly 20%. We issue on-the-run bonds for 10 and 30 years, and we use switch auction to enhance liquidity by tapping the off-the-run bonds. Both the principal and interest are CPI linked, and there is no floor limit for the inflation, and the index calculated by the Israeli Central Bureau of Statistics. By the way, our rating is AA- in S&P, and the debt to GDP ratio is 60%. So, as promised, the talk will be short, and I will only want to share with you two simple facts. That's it, not big deal. So, fact number one, there is an increasing trend of inflation-linked bond globally. You can see it nice and clear in the lower left chart. The right-hand chart shows breakdown by countries. So as shown, US in absolute term is the largest issuer by far, following by the UK, Brazil, Germany, Mexico, and also Israel. So why there is an increased trend? So advantage number one related to the supply side consideration. Basically, issuing inflation-linked bond assists to diversify the source of funding as shown in the left-hand chart. Second, inflation-linked bond assists to create diversified and efficient debt strategy in terms of cost and risk as shown in the right-hand chart. Advantage number two related more to the demand side consideration. So basically, long-term saving institutions like pension fund and insurance company are natural buyers of inflation-linked bond. As shown in the left-hand chart, 55% from the holding in tradable, Israel tradable bonds are long-term saving institutions. Second, inflation-linked bond assists to some extent, assist investor also in terms of diversification. So, for example, you can see in the right-hand chart that the global linker index, the correlation between the global linker index and the Euro stocks is negative 0.3. So there is also diversification benefit for investors. Other possible advantages, so cyclical benefits. Usually there is a positive correlation between inflation and growth. So when inflation increases, the cost of inflation-linked bond increases. However, the growth increases as well, which increases tax revenue, decreases the refinancing needs, and also improve debt metrics like debt to GDP ratio. So basically, servicing inflation cost may tend to be fiscal stabilizer compared to nominal debt. Second, correlation with government revenues. So future tax revenue should reflect the real activity economy. So rational expectation should assume that the revenue side edge the cost of inflation, which seems as common sense. However, sometimes expectations are irrational and sense is not so common. This one's the second joke. So, okay, you are not allowed. So the problem is also the expenditure side is correlated with the correlation. And usually because the expenditure is higher than the revenue side, so basically net you have exposure rather than natural edge. Third, positive credibility feedback. So this might be true to some extent for countries with high-digit inflation. And also for inflation expectation, so nice to have, you don't have to have it. There is other instruments, for example, real rate swap. So fact number 2, so despite the increase in trend, the share of inflation-linked bonds remain relatively low globally. So in the left-hand chart, we can see that roughly 12% from the 22 trillion US dollars is a linked bond. More interesting is the right-hand chart. Basically, we can see that 14 out of 21 countries share, the share of linkers is below 25%. So the question is, why don't debt managers issue more inflation-linked bonds? Like everything in life, there is also disadvantages, obviously. So disadvantage number 1, linkers are less liquid, as Robert mentioned. So you can see that the daily volume of linkers is roughly third from the total daily volume. Although this leads to the chicken egg question, because volumes are low because low issuances, and issuances are low due to low volume. So this is kind of a cycle. Second, inflation is volatile and therefore increased volatility in the deficit, in the interest payment, and also in the debt. However, as shown in the lower table, the volatility has been reduced dramatically. So this is less than an issue for the recent years. Other possible disadvantage, so cannibalization between nominal bond and linkers. This is also might be true to some extent because linkers have natural buyers, the pension fund and insurance company. So I'm not sure it's a real drawback. Complexity in pricing, sure. Inflation-linked bonds are more complicated in terms of pricing. Index reliability, prepare yourself. So basically, it depends on the reliability of the Central Bureau of Statistics. So this can be tricky because, you know, as Mark Twain said, there are lies, damned lies, and statistics. So you can never know. I heard the joke. So finally, so one interesting way to compare between linkers and nominal bonds are the break-even inflation, which calculated as the difference between nominal yield and real yield. So basically, when the break-even inflation is higher than the actual inflation, issuing linkers is economic-wise. So in the right-hand chart, you can see In the yellow line, this is the break-even. In the blue line, this is the actual inflation. And in the lower chart, there is this is the difference. So as shown for Israel, most of the time the break-even is higher than the actual inflation, which makes sense to issue linkers. But we have to see that it's not for the whole period. There are periods that it's the opposite. For example, in times of crisis, like 2001, and also in the global financial crisis of 07-08. Also, is it true for all the economies? Also, not really. We can see, for example, in the US, that the break-even inflation is lower than the actual inflation. So, to conclude, and I did it, and I have more 5 minutes. Not bad. Okay. So, the share of inflation is remain relatively low globally. However, the trend has been moving towards greater issuances. Like any debt securities, there are advantages and disadvantages. Weighting the pros and cons at the strategic level along with tactical analysis such as inflation break-even and other specific characteristics of each economy are key factors for debt managers to decide whether to issue or not an inflation-linked bond. So, thank you very much.
Thanks a lot, Lear. I really liked the map that you shown with the dates when each sovereign started issuing and the countries that issue linkers. Thanks for the jokes as well.
I did know that.
So very quickly, when you started the story showing the share of linkers and in a way justifying this high share because of this history of high inflation, I immediately related to that, coming from Brazil, and I think this is a reality in some emerging economies, that if you come from periods of very high inflation, you may find out that investors are really not willing to go for long-term fixed rate, right? And you may end up with linkers just because it's kind of the what is available for you. But let's move then to the Q&A session. So we had these 3 presentations. I think there are many angles that you may want to cover. So instead of starting myself, I will immediately open the floor to the audience. And you have mics in your tables and also standing mics there. So please.
Yeah, thank you. Very interesting presentations. I wondered, when we think about the issue of sort of a maximum percentage in inflation-linked bonds, if there's an issue related to sort of risk of explicit default, because you, sort of by definition, you can't inflate your way out of inflation-linked debt. If the inflation-linked becomes too high a proportion, then the government loses that ability to sort of inflate away the debt, which might be good, but then it might push you to a explicit default rather than an implicit default via inflation.
Thank you so much. I'll let all the 3 speakers, if you want, address the question. Before that, I from the presentations only, I saw that in the case of South Africa, Jim, you have an explicit target for the medium term. It wasn't clear for me if Israel, if you also have a target for that. And what I understood from the UK is that you do, but it's a kind of short-term one. You mentioned this target for this year only, but I'm not sure if you have a view on the medium term, and especially on this particular issue. Who wants to start?
Shall I kick off? I'll just kick off very quickly. Actually, just to the last point, we don't have a target. What we do say, absolutely, as you correctly said, is what we're going to issue in the year, but that's not so much a target in terms of strategy, because that won't really necessarily have a big effect on the portfolio. That's just to make sure that we are transparent to the market about our issuance plans for the year. But to your question, which is a really interesting one, I think I recall a conversation which I had with someone a few years ago, which went along the lines of, well, the only way you can really ever ultimately reduce debt as a government, fiscal balance is so rare. Having a balanced budget, or so, is by just inflating the thing away. It was said to me partly in jest. If you look at history, actually, there's a lot to it. the point is you can't really have that as a policy, because if you did, no one would buy your bonds. There's a small matter of credibility, which happens to be rather important for us debt managers. So, and very genuinely, if you like, any interest that we have at the moment in reducing future inflation exposure is not because, oh damn, I can only inflate away 3/4 of my debt or 2/3 or half or whatever it is. It's actually something which I think is perhaps more important. It's that if you have such a large exposure and an ever-growing exposure, there's an onus to try and rationalize or justify on sound governance, questions of political economy. On what basis are you such an outlier compared, for instance, to other countries? What is the rationale? Why are you willing to entertain a world where you have, let's say, 1/3 of your debt linked to inflation, or even half? Now, there are academic arguments in favor of that, but they tend to be very academic. I know one or two academics in the UK who do think along those lines. But if we're at 26-27%, the next country, I think, in terms of proportion of their debt highest is probably Italy, just over 8%, 8.5%. The US may indeed have the biggest market in absolute terms, but in percentage terms, it's not that big at all. It's less than a number of countries. And we struggle to justify that. We can't really. And to have something that just grows irrationally, I don't think is very prudent either. So we don't have a goal genuinely of trying to inflate away the debt, but we do have a desire to constrain something we cannot even justify to ourselves.
Thanks, Robert. Jim, would you like to go, sir?
Yes. No, I'll try. Thank you. Thanks for the question. Perhaps to split the answer into two. Yes, to agree with your question, the ILBs do pose a long-term fiscal risk. They just happen to show it over a very much longer time. But over the short term, we are more worried about the rollover in T-bills, all right, causing a default, than your gradual increase in the volume of the ILBs. Yes, on the longer term part, we are worried because it poses a fiscal risk. But on the shorter end, we worried short term, we worried about the more rollovers because they are massive. T-bills are so massive. Because that one is easy to cause a default. And even feeds, if there is a fiscal shock, they are first in line to absorb the shock, and then they feed directly into the debt service cost almost immediately. But linkers have a way of evening out, the increase in the debt service cost somewhat. Thanks.
Thanks, Jim. Lear, please.
So to answer your question, so basically we don't have a target for a specific number. Basically we are just issuing the minimum required in order to have the liquidity in the market, because we're issuing 10 and 30 and we have a curve. We have a unique structure of the designated bond, which basically gives the supply for the pension and insurance company in terms of inflation links. So we are just issuing the minimum level. Also, corporate in Israel, because of the hyperinflation we used to have, still issuing a CPI-linked bond. That's why they need a benchmark curve. So basically, this is our target, how much we are issuing. And to answer your question, I agree totally with Robert. So as policy, it's something that you cannot do it. Is it happen that could it happen? True. But as debt manager, all we can do, we are just refinancing our debt. We are not paying back the debt. So we have to be very careful with that.
Thank you. Other questions? So we have three questions. So let's go the first one here, then at the back, and then here. So please go ahead.
Thanks. Lars from the Danish DMO. We are sometimes getting questions about whether we should be a bit more tactical in terms of issuing this kind of debt, especially at the moment with the QE perhaps coming to an end. And so I was just wondering, is it something that you are taking into account? We also heard Rogoff, inflation is coming. We have break-evens at 135 in Denmark, for a 10-year, that is. So it's just, my question is, do you just keep with your strategic targets, or is this end of QE playing into adjusting strategic targets, or playing it a bit more tactical?
Thanks a lot. So maybe let's start with Leon this time.
I will start. So basically, I think that it's important to concentrate on your benchmark curve. So if you just do it once, opportunistic, and that's it, and you leave the curve with no liquidity and with no other demand, and the investor which would like to receive again the bonds, and you did it only one operation, one time, so maybe it will give you, additional benefit in terms of cost of risk, but maybe it's not worth it. But if it's something that you can continue and you can support the liquid, you can support the liquidity by issuing it on a regular basis for a couple of benchmark terms, then maybe it makes sense. In our case, we came from hyperinflation, so basically it was the tool that we started. We did the opposite trend. Instead of starting from nominal and going to CPI link, we started from CPI link and went to the nominal. The reason, in my view, to continue to have this new instrument, it's only if you can support it, and only if you can do it for consistently, and not just one time, and that's it.
Thanks. Jim, any observations?
Thank you. I think I support, in retrospect, today, looking back 4 or 5 years ago, I support the tactical move. But it's easier being tactical if you don't have too much constraints. For instance, when we started, the main constraint was the refinancing. So we've had to shift the issuance into the longer end and became less tactical. But the only tactical way we came through was through the switches. But then where do you switch? You switch from the short to the long end. Where do you issue? You issue in the long end. So it was a one-directional move in both the switches as well as the issuance plan. But I do support the tactical to the extent you don't have too much constraints in the portfolio. Sure.
Thanks, Jim. Robert, please.
I mean, very briefly, can you hear me? Yes. We don't think about this in terms of the end of QE or the split in those sorts of terms, not least perhaps because actually the Bank of England in its QE exercise haven't bought any inflation-linked bonds at all. They've only been involved in the conventional market, and because these things are sought after so much by the pension fund industry, the pension fund industry would have cried out very loudly if they'd been deprived of their linkers. In terms of the tactical aspect, I mean, I just thought, sort of, the word tactical implies probably one of two things. Either it implies that you're being opportunistic, which, is, God forbid, the worst thing you can say about a debt manager, he's opportunistic. The second thing implies that we have a strategy. Well, if there is, I don't know what it is, so...
Thanks a lot. Actually, before moving to Patricia's question, Lars, let me take advantage of your question and maybe ask you a question. If I'm not wrong, I think Denmark started issuing linkers in 2012. So maybe if you could tell us very briefly about the rationale and how relevant this instrument became in your funding program.
Yeah, we came in a situation where the debt was easy. We started with a very low debt, and then it increased during the financial crisis. So for us, it was a way to increase the investor base, basically. And we also did all the same arguments. I think it fits well in with receipts is increasing, when inflation is increasing, and so on. Then debt has stabilized, and we actually opened a new one, a new 10-year, after 5 years where we built this up. And there was a discussion of whether we should do that or not, because the debt is actually pretty low. So the argument there was, as always, also was mentioned here, does it deprive liquidity from other bond series? We thought it was still prudent to do so, because we have actually a lot of unlending to government-owned entities that use this bond. So the exposure on inflation doesn't actually end up in our books, but at the government-owned companies, and they would have done the inflation-linked by the swap market or something else. So that was part of the reason why we continue. But the Ministry of Finance, I don't think they think it's a good cost benefit. But the argument is it doesn't land on our balance sheet, and then they're okay with it.
Thanks so much. So Patricio, please.
Thank you, Rodrigo. One question first, because for Chile it's a very interesting experience, because in Chile we have in the opposite situation. I think that I mentioned that the local currency bonds was very low in 10 years ago or 15 years ago, but the percentage in inflation-linked bond was at that time the 100%. So we changed from this 100% to the current level of local bonds is around 55% of our local currency debt, and for the old debt it's about 45%. So maybe we are taking a bad decision, because I understand from you that effectively in terms of cost, the linker bonds is more efficient, the cost is lower, because theoretically, basically we understand that if you have the inflation under control, the investor in general would be indifferent between the nominal bonds to inflation-linked bonds. So the question is the following: if you can explain a little bit more why you consider that this is less or lower expensive or than the nominal bonds, in consider, for example, that we have some illiquidity concern regarding these bonds in your home country.
Thanks a lot, Patricio. Maybe we could start with Jim now, and I think if I remember well, both Jim and Robert, they mentioned the cost dimension very explicitly. I don't remember if Leo touched upon this issue directly, but I do remember that Jim, you talked about the premium and how you could have some cost savings from that premium. So maybe we could start with you.
Thanks for the question. Yes, it does contribute to lowering the cost on an average basis, and perhaps that's where the problem comes. Because if you look at where, in our case, the ILBs are averaging is about 3%, but 5 years ago they were less than 1%. And then right now the FRB is about 9% if you compare the 3% to the 9%. So if you look at the overall, if you combine both the ILBs as well as the FRBs, the debt portfolio is about, I think, 6-7% in terms of the cost. Although the share of linkers is quite low, obviously, and that tends to put the average cost or pull the average cost down. But I'm not sure if this depends also on the accounting. Is it the cash, modified cash, accrual? But we use the modified cash, well, on a modified cash basis. So we don't really account for those accruals. The inflation revaluations only going to kick in, obviously, at redemption. So if you look at the books of the government, it seems really very low, but strictly speaking, if you are to be on accrual, you'll have a different picture altogether. Thanks.
Thank you, Jim. So maybe let's move to Robert. And Robert, you mentioned the cost considerations in your first slide. You mentioned that this was part of the regional rationale, but also that you'd even rank it first probably nowadays. So.
I did. I mean, I would say we would rank the importance of the pension fund industry in particular first, but that is linked to the costing. Absolutely. So cost, is a big driver. We have a cost minimization objective. That's why we issue these things. We do not have, for instance, a innovation objective. Let's try this instrument. Let's try that instrument. That's not to say that we shouldn't or anything like that. I'm not trying to pass a value judgment, but we are driven fundamentally by cost. That's the first thing. Secondly, how do you measure it, or how can you actually work that out? Well, basically, you can only do that ex post. You cannot do that, in advance. And for many years, I talked about the inflation, the bout of inflation that the UK had in the 1970s. For many years, inflationary expectations were really firmly embedded in the market. The market felt that actually we would, in the UK, never meet our inflation target. But one thing, in fairness, in spite of all the problems that we've had in the UK, ever since the Bank of England was granted operational independence for implementing monetary policy in 1997, since then, yes, inflation has exceeded its target at times, but inflation in general has come under control. And if you look at it now ex ante compared to, let's say, 20 years ago, ex post, compared to the way it was 20 years ago, in cost terms, actually it is cost effective, especially in the very long maturities, we believe. But actually, in the shorter maturities, it's not that cost effective anymore. So that gives us pause for thought.
Thanks, Robert. Leo, any considerations on the cost?
Sure. So basically, I think that the inflation expectation compared to the actual inflation, this is the key to address to the cost, because it's true that you have a premium risk, but the inflation expectation play much more important role, because, for example, in Israel, because there is memory of the hyperinflation, so basically our nominal bond price most of the time the inflation higher than the actual. By the way, in times of crisis, this is the opposite. So it's very depends on the specific characteristic of each market, and the difference between the inflation expectation and the expectation, actual expectation. This is what will save the real cost compared to the liquidity premium, which may be 10 or 15 basis points. But the difference in those two parameters play important role.
Thanks, Leo. So we have a question from our colleague from Germany.
I think the questions from Chile and Denmark were excellent. I had the same in my mind, but since you were focusing so much on reducing costs, I would be interested in how you measure the additional risk you add to your debt portfolio when issuing inflation-linked bonds, the planning uncertainty you have in your portfolio. How do you cope with that from your portfolio management point of view?
Thanks. Robert, would you like to go first?
Okay, again, really great question. How do you measure the well, basically, it's linked to actually a point which my fellow panelists have mentioned, which is, in particular, you can look at the volatility of debt interest costs in terms of modeling that, and it's actually higher, quite a bit higher for inflation-linked bonds. It's less easy to model because you don't know to a large extent what the applied inflation uplift in the future is actually going to be. So that in itself introduces a risk. I'm not saying it's not manageable, but it introduces a major risk, that to us is something which, again, if you don't have another equally strong rationale to say you're willing to take on that risk, if you can't define your own risk appetite, objectively, then it becomes really quite hard. So measuring that risk is something, as I say, which we do try and do to some extent. And it doesn't mean that, some element of risk appetite we're happy with, but not, I think, in an unconstrained fashion. And you've got to think, if that slightly risky element of your portfolio becomes ever larger in terms of regular debt servicing costs, is that what you should, as a debt manager, prudently wish to actually see in your portfolio?
Thank you. Jim?
Just to add, I think what we've observed is that we look at the monthly change in the CPI and say, what is it that we can roughly tolerate? If you're to go back in history and look at a time series of those monthly change, 0.2, 0.6, 0.8. The highest we can tolerate in our view is about 0.8, because if you were to, increase the CPI with that over time and into the future, you're likely going to have a bump in your evaluations. So that actually we use as an amount we can tolerate or not tolerate at all. So it's just a proxy for saying if the monthly change were to persist as high as 0.8 for 5 years into the future, 10 years into the future, by how much can the revaluation increase and therefore even skew you away from either the ratio or increase the volume of debt by a certain amount. Sure.
Thanks, Jim. Leo.
Yeah, so basically in my presentation there is the cost risk model that we use. So as Robert said, we look on the volatility on the side of the cost. We also add the inflation, and we look on the volatility. And basically you can see that the portfolio with significant CPI, so they are more volatile, so they are more riskier, but with lower cost. But not just volatility, we also look on the tail, on the 95%. We also look on the expected shortfall on several indicators. But I have to say that the model is very nice. We use Monte Carlo simulation, etc., and trying to figure out what will be the inflation. But at the end of the day, those are only guidelines, because there are a strategic level which we would like to support by issuing the inflation-linked bond in terms of diversification of investor base, in terms of liquidity. So the cost is not the last word in the game. It's just the beginning to trying to understand which strategy is you feel more comfortable in terms of cost and risk, and then we implement other strategic targets, and then we decide about the strategic funding of the next year.
Thanks a lot, Lear. If I may just add one quick comment before passing the floor to Herman from Uruguay. Also something that I know it's obvious, but it may not be trivial, is that when we talk about cost and risk, it all depends on how we measure those things, right? And why I'm saying that is that I remember, again, back in my previous life at the Brazilian Treasury, I remember at some point we were doing some cost risk analysis, looking only at nominal cash flows. And we were getting the type of intuitive results that if you want to go for low-risk portfolios, you go for long-term fixed rate and those type of stuff. At some point, we started trying, let's say, incorporating some kind of an ALM feature, saying, well, what if we measure that not only in nominal terms, but to GDP, and we incorporate the future surpluses and the potential correlations with the economic variables. And when we did that, we suddenly realized that in that kind of modeling, let's say, even in the low-risk portfolios, inflation linkers would show up with a relevant share. Herman, I think you had either a question or a comment, please.
Just a comment on the experience of Uruguay. Just as in the case of Israel, our de-dollarization strategy first started with issuing inflation-linked bonds, and only after a long while did we issue nominal fixed rate. Now, one thing we noticed, mostly thinking from the demand side, more than from the supply side, is that when we issued inflation-linked bonds globally, and that was only 1 year, 2 years after our crisis, we tend to see that investors, international investors, found it appealing because they saw inflation-linked bonds as a best proxy for dollar debt. In countries that have a high pass-through from exchange rate to prices, inflation, in the absence of foreign currency debt, is the best hedge for investors. Thinking in terms of the demand side, because mostly pension funds tend to think the returns in terms of a CPI domestic basket. But foreign investors tend to think their returns in dollars, even for local currency instruments. So that's just one comment that we saw for the case of Uruguay.
Oh, thanks a lot, Herman. I think you brought a very important point. That was more or less the history in Brazil as well. It was a bit what happened in Mexico, and actually we see some countries that currently have those type of domestic FX-linked bonds, and maybe the inflation linkers could be an option for the government to move away from this FX. So thanks a lot. Please.
So for now, I want to thank all the panelists for the great presentations. And my question is for Jim. In your presentation, you mentioned you're dealing with uncovered auctions because the primary dealers, they don't have obligation to warehouse the securities. And the question is, have you ever considered using syndication to issue these securities? It seems that syndication would allow for some better pricing and timing of the market as opposed to auctions.
No, thanks for the question. Not as yet considered the syndication. I think if I can talk to my colleagues in the front office to see how they take to that. But we've always been using the banks, the primary dealers, although they are not obliged. So everybody who wants to buy the linkers have to go through them, but they are not obliged, as they are on the nominal side, to be making, coming to the auction, the primary market, to submit those bids. But as to the syndication idea, I think I can take it up with our front office guys. Thanks.
Thanks, Jim. Let me take advantage of your question and actually ask a follow-up question for all. If you use particular methods for linkers compared to the conventional bonds, meaning either using more syndications that we learned that you don't, but also the type of auction. If you mentioned that at some point at least, as far as I understood, you were using multiple price for the conventional bonds and single price for the linkers. So I would like to ask you if that's the case still, and maybe have Leo and Robert commenting on that.
I think for starters, perhaps to be clear, the uniform pricing was started off with the FRBs or the conventional bonds, but with the ILBs we started with the first two auctions because we struggled with the pricing. Subsequently, we went on multiple pricing, but that was a problem. And then we switched back to uniform pricing about 2005. It contributed a little bit because, roughly speaking, you had most of the auction being fully subscribed on a uniform pricing basis compared to being on the multiple pricing basis. That is just our experience. Yeah.
Thanks. Leo, any consideration?
So in our case, the obligation of the primary dealers are equally both for the linkers and also for the nominal. The method issuance is the same. Everything is the same. The only difference is that in the nominal we are supporting 4 benchmark terms, 3, 5, 10, and 30, but in the linkers we only issue for 10 and 30 years. In order to solve the liquidity problem, we are using on a regular basis on switch auction, which is basically 15% from our issuances, and then we just switch short maturity bonds with long-term maturity bonds, and this gives additional liquidity because we are not issuing directly to the short end of the curve. So we're trying to give more liquidity.
Thanks. Robert, and how's that in the UK?
Actually, it's exactly as Rodrigo just said. Indeed, we have these two auction formats, and indeed, we currently use and have always used a single price format for inflation-linked bonds and a multiple price format for nominal for conventional bonds. And the reason for that is basically to do with the way the market works. And I talked about liquidity between the two asset classes. There's a lot of academic work on in auctions on things such as sort of auction methodology and those sorts of things. Some very sort of interesting work too. And one of the things that comes out of that academic curse is a phrase which I'm sure many of you will have heard about, the winner's curse. And the use of a single price format for inflation-linked auctions is because this is, or in relative terms, a less liquid market. Basically, it does protect the bidder from that. And it's interesting, until 2009, when we had an uncovered conventional auction, the first 3 years of the DMO's existence, we've been around for 20 years, but between 1998 and 2000, at the end of 2002, there were 2 uncovered auctions, or 3 uncovered auctions. They were all inflation-linked ones. That wasn't because there wasn't demand, it's because the market didn't actually function that well. The auction process didn't function that well. So, by having a single price format, you do to a large extent make the actual auction mechanism process that much easier.
Thanks a lot, Robert. Chidam, I believe you had a question.
Yes, thank you. This is an excellent session so far. So my question is, let's see the rest. Let's see the rest. Okay. So when Turkey was thinking about introducing the linkers, I know that they spent quite a bit of time thinking through the impact on the credibility of the monetary policy, because Turkey was following an inflation targeting regime at the time. But Robert mentioned as one of the objectives of issuing the linkers in the first place was to be able to issue at times of high inflation uncertainty. So how do you reconcile, the credibility of monetary policy versus starting to issue linkers? Maybe it's not the case for the UK anymore, but for countries who are thinking about issuing the linkers, starting to issue them.
Thanks. Now it's a big responsibility, right? Robert, please.
Yeah. I'm not a central banker, mercifully, for probably the economy, actually. But in the UK's case, you have to remember that when we started issuing in 1981, monetary policy was actually conducted by the Treasury, effectively. The bank did what it was told. And in sort of more modern times, that's no longer regarded as the model that we would want to pursue. So it's only sort of in the last 20 years that that's actually changed. You have this separation. And I think that's probably quite relevant. So, what we issue, we do not have any, I think it's fair to say, we don't have any regard for what we think the monetary policy will be. That plays no role in our decision-making. And whether or not the bank is going to meet its inflation target also plays no role in our decision-making. So we're not trying to sort of, if you like, second-guess monetary policy or the effectiveness of monetary policy. That is genuinely separate. But I think it's easier, obviously, to do. You can only do that when you actually have that institutional separation between the two. Then otherwise I think it gets quite difficult to rationalize how you do that.
Thanks a lot. Jim, Lear, any consideration from your side that you'd like to comment?
Just briefly to quote what the governor often say when rating agencies ask him the very same question. He normally says, I think there are three ways to look at inflation expectations. First one is the survey by the Bureau of Economic Research, and then market consensus, the second one, and then the third one would be, I think, the break-even inflation. But they tend to lean more towards the survey as opposed to just relying on one being the break-even. Normally they just look at the surveys. Yeah, sure.
Thanks a lot, Jim. So we're about to close the session, and Jim helped me here because I was thinking of how to close the session after we talked about such different topics, right? But he mentioned the rating agencies, and I would like to close just telling you an interesting story, at least I think, is that I remember when we started in Brazil issuing these linkers on a constant basis in the beginning of the 2000s, still the rating agencies would visit us and they would see these instruments as having like similar risks to the FX debt. They would say, well, what matters to me is how much you have on nominal debt, on fixed rate debt, and the rest is only variable rate debt. And I remember that we had discussions that went on for maybe years to convince them that these risks are completely different. And you have a case to have inflation linkers, and we talked about all these advantages, including those advantages that comes from, again, from kind of an ALM type of consideration. This would also connect, tomorrow we're going to have a plenary session about asset and liability management. I think sometimes when we talk about linkers, we have this argument behind of the correlation of the revenues. I remember that on our last forum in 2016, we had Andy from the New Zealand DMO, and he was telling a very interesting story that a few years ago, doing some research exactly on the characteristics of the government revenues, it was when they decided to increase the share of linkers. And the share of linkers was almost nothing at that point. I think this was 2012, and they became around 20% of that, if I'm not wrong. So Josh will be moderating that session tomorrow. We can come back to this issue. Before closing, I'd like to say a big thanks again to all our speakers. It was really a pleasure. Big thanks to your participation, to your questions. And finally, just highlight that we're going to have the coffee break now. And at 4:30, we're going to have 2 other breakout sessions. So you can choose between breakout session 5, which is going to be in this room, about thematic bonds, blossoms of the bond market, or the breakout session 6, which is about mind the gap, seeking public and private sector collaboration for improved debt transparency, which is going to be in the 13th floor. If you want to go to that room on the 13th floor, unfortunately, the building of the bank is not very straightforward to find your way. So we would recommend everyone that wants to go to the other room coming down to the ground floor where we have the plenary, and then we're going to take a different elevator to go to the 13th floor. Sorry about that, but we're going to be there to help you. So thank you.